Hessam, welcome to Seeking Alpha CEO Interviews. Really thrilled to have you on the show, so thank you so much for taking the time.
It's my pleasure to be part of the program. Thanks for having me.
So catch listeners up, those that may have heard of you, but those that are unfamiliar with Marcus and Millichap, catch us up on exactly where you fit in the real estate industry.
That would be my pleasure. Our company was founded in 1971. This is our 50-year anniversary this year, and we're really excited about that. And the company was created because of the lack of investment brokerage specialization in the industry, where a platform was dedicated to creating value for real estate owners that wanted to market their properties. Even today, the information sharing, the specialization, training, and dedication to the skill set that is required to find the right buyer, the largest pool of buyers for each asset, is a big challenge in the industry, especially back then, of course. And our founder, George Marcus, and co-founder, who joined later, Bill Millichap, recognized this need in the marketplace and dedicated the entire platform to this one niche in the business that everyone else was ignoring. So we have created the technology around the information sharing to make a market for each asset. We have the boots on the ground with the largest investment sales force of its kind throughout North America now, including Canada, that specialize in investment brokerage by property type, every segment of commercial real estate, from apartments to shopping centers to seniors housing, self-storage, and so on, and financing, where we as intermediaries find the best loans, whether it's for a purchase or a refinance, by exposing each of our clients, each of our borrowers, to as many lenders as possible who bid for their business. And this has really put us in a unique position in that most of our peer group specializes in larger assets and institutional type of services, as well as many different services like leasing and property management and other types of activities, where we felt specializing in investment brokerage and finance was going to create an advantage for our clients. In the most recent kind of advancement of the platform, we've also added an institutional arm for the company that really helps private investors that we've grown up with over the years, the predominant client base of the company, become more involved with larger assets and migrate their equity in smaller assets into fewer but larger and high quality assets. That migration of capital as the aging baby boomers look toward retirement and passing on their estates, we noticed about 10 years ago would be a very important trend. So we created an institutional division to do that, as well as bringing the private client capital to our institutional clients. So that diversification for us has really paid off well.
Interesting. The other thing that I was interested in talking to you about is the evolution of the industry since you've come on board. What are the trends that you've seen? And obviously this past year has been, such a crazy time for every sector, but certainly in the real estate sector. As you've seen the real estate industry kind of change and develop and different trends develop, what have you seen up until this year, this pre-COVID? And then since then, how have those trends kind of come into effect in a different way?
Sure. From a brokerage service perspective, what we've seen is the importance of technology. Everyone talks about it, but in real terms, in real time, the effective technology in the way you underwrite assets, in the way that you expose each property to the right pool of buyers. I mentioned that's how our company was founded, to do that. And because of that, we have this technology DNA that forced us very early in the evolution of the company to have electronic inventory databases, to have buyers selling matching techniques and technology around this market making for each property. And fast forward to the 2000s and the last 5 to 7 years, the evolution and the pace of change in those technologies has been at a breakneck speed. On top of that, the private investors that, as I mentioned, are the predominant client base that we were created to service because they were so underserved, have become more sophisticated. They are a lot more educated, and they have access to a lot of information on their own. So being the professional intermediary that is really an advisor and has the education on the ground, corner of North and Main and the particular asset class, an apartment or shopping center that a client owns, and knowing everything about that submarket, that neighborhood, that asset, and bringing that value to the client, both in terms of the information and the knowledge, but the delivery of it has been an unbelievable evolution for the industry. We have had proprietary technology since the founding of the company, and we continue to replace our own systems every few years. In the last 5 years since I became CEO, we have more than tripled our investment in technology because of the fact that the pace has really picked up, and we want to be leading it and not following it.
It's interesting. There are certain trends that are extending across every sector, right? There's the need to be technologically adept is now across all sectors. And the fact that it's now part of almost every sector is really a real strategy that everybody needs to kind of grapple with. The other thing that I feel like is coming into play, especially with COVID, is these different trends in both in commercial real estate, obviously, but also in residential real estate, which I think is affected partly because of COVID, partly because of what that's done to people's lives and how they work and how they live and where they want to live. But also, I think a result of these low interest rates, and at times zero interest rates, and what that's done to the market. I'd love to get your thoughts on how that's affected both parts of the sector, both in the commercial and in the residential.
Absolutely. So leading up to COVID, everything we just talked about had already been, hyper powerful, if you will, or very potent as forces in commercial real estate. And of course, residential has had the MLS and variety of technologies around that has really become more of a commodity for a commodity asset, where looking at a house, a single-family home, is a entirely different process than looking at a commercial asset of any kind that has a variety of characteristics in terms of the physical asset, in terms of the rents, the occupancies, the tenant profile, what the owner has done to upkeep the capital investments to keep the asset competitive, raising rents or being competitive in terms of rents and retention of tenants. It's a completely different ballgame from an underwriting and an investment evaluation perspective. Going into COVID, what was remarkable to see is the investment in technology for the prior 5 years paying off for us almost overnight, in that we were able to almost literally flip a switch and go virtual with over 3,400 people that make up our company, both in terms of our 2,000 plus sales force, as well as the management team and support staff throughout North America, without skipping a beat. Had we not been investing in those kinds of technologies that allow remote access, virtual presentations, of course, in a variety of different automation technologies that we've implemented, there would have been a massive disruption to our business. And thankfully, we passed the test, and that was one of our key advantages during the pandemic. In fact, we rolled out an update to our website in August of last year that was really kind of catering to the ease of use for investors in seeing our inventory for sale and getting access to our research content at a time of great uncertainty. And that has generated unbelievable results in terms of matching inventory to buyers. So the test was really during the worst of the COVID pandemic with the lockdowns and so on. We proved to ourselves and the industry that the application of technology can be so important and so well executed that looking well beyond COVID, we're looking at ways to continue to leverage that technology and not to replace the in-person interactions with our clients. We'd never do that because the real estate business is a people business. Internally, for our training and team management and interaction, we're very eager to get everybody back in the office. But at the same time, the advantages of the combination of in-person and virtual execution of the business are factors that we're really looking into for a long-term strategy. On the residential side, that's been around for a long time. But again, so it's nothing new. Again, from an underwriting and financial analysis and a buyer making a decision on acquiring a single family asset versus a commercial asset, those are totally different worlds.
Mm-hmm. I'm curious, you've kind of come up through Marcus and Millichap and had a variety of roles. As as you're describing that you guys have laid the groundwork so you were able to succeed in an extraordinarily difficult year, and something I keep coming back to in talking to management is you have to be smart to be lucky. And the people that are laying the groundwork ahead of the time are the ones that are able to reap the rewards when all the other companies that have been unprepared are scrambling and looking around for solutions, that tend to be more stopgap measures than any long-term solutions. So I'm curious, because also you've come up through strategy and marketing. What is your thought process in terms of looking at the field and knowing when to start initiating something that is going to be implemented in the future? How far ahead are you looking at that and thinking about those types of strategies?
I love that question because it really speaks to the values, the founding principles and values of our company. Our founders really believed in creating a healthy business and never got over their skis. We've never had any debt. We have built the strongest balance sheet in our peer set by having a record amount of cash, no debt, and always being prepared for the fact that the real estate business is cyclical. The U.S. economy is cyclical. And our founding mission was always to be there to help our clients during the good times and the bad times, and to support our team during the good times and bad times. The amount of investment we make in training, in our market research, which has become one of the key draws of why our clients do business with us, is because of our research. And of course, the technology investments we talked about were paramount during good times and really paid off during bad times. And so sticking with what we're really good at and not getting ahead of ourselves has been an incredibly important part of our DNA, as well as the technology orientation I talked about earlier. As I was fortunate enough to join the company when it was small and private, before it became a national powerhouse and before it became a publicly traded firm, I was excited to bring the research component, the advisory component, to what had been a transactional model where we had the best brokers in the business as market makers, boots on the ground, and being able to solve any problem for the client, for the investor, and not just take the easy deals. We take the hard deals. We can find the right buyer for the right asset, no matter where it is and no matter what condition the asset is in. And that's always set us apart. Add the advisory component, a third-party, very seriously designed research component that is objective, that is forecast-oriented, and all of a sudden the combination of that execution capability and the advisory, research, and information capability brought together through technology became an explosive combination of an organic growth. We went from, I think I joined the company at 18 offices. Today we have over 80 offices. We had 350 brokers. We now have over 2,000. All of that literally was created organically by opening offices, finding managers, and training people and attracting and keeping them. In the last 3 years, we have augmented that with a pretty aggressive acquisition strategy. Our organic growth and training system is better than anything that exists out there, but it can be augmented by attracting accomplished individuals and companies, boutique firms that are out there doing this on their own and can really benefit from our platform where we have service gaps or where we want to expand, which is another exciting part of our strategy is even though we have the highest market share by a number of transactions in the real estate investment business, we have roughly a 10% market share because the business is so fragmented. The top 10 brokers, including us, have roughly a 25% market share. And so the rest of it is done by local firms, individuals, a lot of trading that goes on from principal to principal without an intermediary, which in this day and age is still sort of shocking because of the importance of how an intermediary can create value. So we have a phenomenal growth opportunity ahead of us with a combination of our organic growth and more recently augmented by our acquisition strategy.
And talk to me a little bit, talk to listeners a little bit about those acquisitions that you've made in the past year and why you brought those teams on, what gaps that they're filling and what they're bringing to you guys as an entire entity.
Well, we, as I mentioned, are the dominant broker on the investment sales side. And roughly 15 years ago, we added the financing component where we have about 100 loan professionals or capital markets professionals finding the right financing for our clients. That part of the business can grow exponentially, both in terms of capturing the financing opportunity for our internal sales transactions and just offering refinance, recapitalization, and a variety of different capital market solutions to our clients. And so there's been a lot of focus on acquiring financing intermediaries. We bought several firms, boutique firms that were independent, that have been just phenomenal additions where we had no financing. There are still more than a dozen metros where we currently don't have a financing presence. Those are ripe for addition of experienced individuals, teams, or acquisition of firms. And in addition, and we're the dominant apartment broker, we're the dominant retail broker throughout North America. In office, industrial, and other property types, there is a significant opportunity to acquire folks that specialize in those segments, particularly multi-tenant shopping centers and office buildings and industrial in growth markets like Texas, like Atlanta, like Florida, for example, the Carolinas. These are phenomenal growth markets because of demographics, and we're looking to expand the platform to capture that. On the West Coast, where we started, and therefore we have a lot more offices and a higher density of exposure to markets, even there we have a phenomenal growth opportunity in all these segments. And everything you hear about California and New York and the exodus and so on is really cyclical. We really believe in those markets as much as we believe in the growth markets I talked about, including Arizona, Nevada. I mean, these are all growth markets. Even the Pacific Northwest. But the established mature markets also have almost unlimited growth opportunity because you have to remember the private client is in the millions, and the vast majority of assets in commercial real estate are owned by private clients. They always have personal circumstances like death, divorce, partnership breakups. They're at times of distress, like last year, like in the 08-09 recession. They need to raise liquidity for other reasons in life. Therefore, they're motivated to sell their assets or exchange their assets. And they're also entrepreneurial. So whenever there is a disruption in the market, we have a significant amount of clients that are ready with cash and an entrepreneurial spirit to come in and enter opportunity segments for the marketplace. So we're really in the middle of all that, and we position ourselves to be able to facilitate this entire dynamic in a very dynamic and vibrant marketplace.
And what are you seeing in terms of, you talked a little bit about the commercial real estate, especially in the urban centers. You talked about things being cyclical. I live in a major international city. I have family in major cities in the States, and we're all experiencing the same thing, which is people have refinanced their homes. There's a lot less on the market. There's a supply glut. And yet, in the commercial sense, it feels like there's been new uses put to kind of these big buildings. What are you seeing in that regard?
Let me remark on the urban flight, because COVID really hit urban areas very, very hard. Pre-COVID, we'd already seen the aging of the millennials who had driven a lot of job creation and sort of 24 cities where young adults wanted to be near work, didn't want to commute, and really enjoyed the amenities and the lifestyle of urban America. You had renters by choice who sold their homes as they became aging baby boomers or empty nesters and preferred to rent high-end apartments in downtown areas over the last 5 to 7 years. And that created an urban America boom. And it was going well. But as the millennials were aging and starting to get married and form families, they were already beginning to move back toward the suburbs. So we began to see that over the last 2 to 3 years. Behind them, there's a new generation of people coming, not to the same degree that we saw in the last 10 years. So there's already a shift in process. Not to say that urban America was in trouble, but there was already some things that were changing. COVID accelerated that exponentially, of course, with the exodus. And suburban areas are really benefiting from that. The work from home phenomenon has really created the question mark of what is the long-term use of office space. We really believe this is cyclical. People have short memories. As soon as the vaccine is truly implemented and proven and people feel safe again to get back on trains and buses and public transportation, which is really important for urban America workforce, assembly. And we began to get over the fact that this fear factor is no longer with us. We're going to see people come back into office space and downtown areas. It'll be gradual. Just like us, as I mentioned, there's some permanent opportunities to change the business model because we've proven the virtual work from home can work so well as a supplement to being together. I think a lot of companies are going to do that. So that inherently reduces office space demand. But on the flip side, we're about to go into a significant economic expansion. There's a lot of pent-up demand in this economy because consumers couldn't spend the kind of money they would normally spend. And with a new wave of job creation and economic recovery, you're going to see new demand for office space. So net, I don't think we're going to see a big permanent destruction of urban America versus suburban America. I think there's plenty of demand to go around. It's just going to take a while for that urban recovery to occur. And our clients are seeing that. We have a lot of opportunistic investors right now that are investing in urban America because of these trends that we just discussed.
It's interesting. The city where I am is Tel Aviv, and I feel like I might be talking from your future that you're talking about because we've had, the vaccine success that we've had, and it's exactly what you're describing. The city has opened up, and where prices had been going down all throughout COVID in the city, they're soaring right now, to a ridiculous degree almost. It's going the other way, and office buildings are starting to open up. So everything that you're saying, I think, is true. And I think what we've lost in this crazy, crazy year is the perspective, because we've had no perspective on this, because it's been so, ever changing and coming at us all the time. But I think what you're saying is right? Like even global pandemics wax and wane. And even within all of this, terrible news and economic destruction, I think there's the flip side of that when things start to wake up and pick up and vaccines start to be more widespread. So I feel like you agree with that. How far do you feel like the timeline is in terms of, let's say, the major urban areas like California, New York? Do you feel like it's just a matter of months in terms of the vaccines being more adopted in a wider population?
Well, no one really knows, but logic would dictate, assuming that we continue seeing progress on the vaccine front, and there may be some bumps in the road, like the Johnson & Johnson vaccine concerns that came up just in the last 24, 48 hours, are resolved. Really, in the next 18 to 24 months, we should see that return to being comfortable, being in office space, being congregating with colleagues, and so on and so forth. But there are other things that are at play. Depending on the market area, we have housing affordability issues, we have taxation issues, we have regulatory issues that are discouraging a lot of developers to invest in certain metros or certain states. Those issues were with us pre-COVID. They're going to be with us post-COVID, and so they haven't gone away. We still have to deal with that. But going back to an earlier question you asked about reuse, I don't think the urban America phenomenon that we've seen because of COVID is going to create a massive wave of reuse of assets. There's going to be some of it, but the reuse that we've already begun to see, and we're going to see more of, is in segments like shopping centers. The devastation on restaurants and fitness centers and experiential retail, like movie theaters, that were the hottest segments of retail pre-COVID. Because unlike online shopping, they attracted foot traffic, they attracted people, and therefore retail sales were supported by those segments of retail. which were devastated during COVID. And some of those businesses are just not going to make it back. But a lot of them will make it back. New ones will spring up. And the reuse of retail to other uses, such as education campuses, such as healthcare applications, and other applications, is only going to accelerate. We're actually seeing a revitalization of shopping centers and retail, where a lot of opportunistic investors are coming in for the higher yield, higher risk profile of retail, and transactions are happening right now that are based on future reuse or reuse plans. That's just one example of how commercial real estate is morphing and evolving. And the last point I'll make on that is that if you go back 30, 40 years, commercial real estate would overbuilt in every boom, and there would be a recession, there would be a major oversupply, and of course a major correction, price correction, and so on. And off we went in this repeated cycle of overbuilding. The last 10 years have really changed that. We did not overbuild commercial real estate during the expansion from 2010 to 2019. And even apartments, where there was record number of new units being delivered, were being absorbed very strongly because of the demand. Office space wasn't overbuilt. Shopping centers were contracting at a significant rate, and rightfully so, because e-commerce has really revolutionized the way people consume and the way people shop. So that is a major advantage, in that there wasn't this glut of overbuilding before we had the COVID demand shock. And so I think because of the pent-up demand being released in the back half of this year into next year, I'm seeing forecasts for GDP growth ranging from 6% to 8%, the highest since 1950. We're going to see a significant recovery, more than a recovery, really. In some ways, when we had Ben Bernanke as a guest speaker on one of our client webcasts last fall, and I asked him if this is going to be like a roaring 20s style of or magnitude of an expansion, at least for a period. And he basically wouldn't go on record as saying, yes, I think so, but he intimated that there should be a big benefit from the release of pent-up demand.
Yeah, I mean, it's interesting. The Roaring 20s happened because of World War I, and I would say that COVID is, equivalent to World War I in terms of the change that it's caused in people and in terms of their thought process. And I think the change in going from one extreme to the other is probably relevant as well. Within all of these difficult challenges and all these hurdles, you guys have experienced some record numbers. How were you able to do that? Do you attribute it to smart strategy? Do you attribute it to the accretive acquisitions that you onboarded this year? What are some of your thoughts about how you were able to achieve that?
It's a combination of everything you just mentioned, but most importantly, it's that founding principle of always being prepared and always being educational and present with the clients in good times and in bad times. And last year was the absolute example of a shutdown in the marketplace. We saw transaction activity and our pipeline drop at the fastest rate we've ever seen, of course, because of an economic lockdown. And so we had a choice. You could wait and see what happens, or you could lean into the storm by flooding the zone with as much information as we could provide to our clients, as much education as we could provide to our sales force. We're lucky, very fortunate, to have many of our brokers who've been with the company for 10 years or more, 20 years or more, and have been through cycles. So we leveraged them. Over 50 of our top producers came on personal webcasts hosted by a variety of our management team, talking about deal mechanics, how to help clients by property type, their own best practices of what they're doing to get through this very unusual period of not being able to interact with anybody. We've been through downturns before, but you never had to get through a downturn working from home. You could still meet with clients, you could still meet with lenders, you could still meet with your manager and get advice in person. This was really unusual because you had the market component of it and you had the virtual component of it at the same time. But by flooding the zone with information for the client base and education for our own sales force, we were able to keep things moving. And part of the reason we had a record fourth quarter, best fourth quarter in 50 years, is because of the seeds that were planted in March, April, May of last year, as the crisis was basically, coming down on us, and not waiting to see what happens. We didn't lose a day. We were out in March with our first market overview session that drove close to 20,000 clients. And we went from there and had educational sessions every week internally and monthly for our clients. And that drew a lot of people in who needed to have problems solved. Our philosophy has always been, you have to solve the problem for the client if there is a downturn. And you have to, on the flip side, you have to be able to find opportunities for entrepreneurial investors that make up so much of our client base at the same time, but still making good deals. We're fortunate that the Fed was very responsive this time, and the government stimulus came within 7 weeks. Think about that. Within 7 weeks, we had the first round of stimulus compared to 13 months in 08, 09. It took 13 months for TARP, which was the most significant stimulus package that was injected in the system back then, to show up. That made a significant difference. You talked about almost zero interest rates. The interest rate environment was very helpful to lubricate the marketplace. The availability of capital, because the Fed's stepping up and backstopping and supporting the commercial paper market and keeping the credit flow going after a freeze in the second quarter, were all very helpful. So we could do what our clients needed us to do because of these tools that the Fed was providing. The magnitude of the stimulus is now at 25, close to 30% of GDP, compared to just 6.5% in 08, 09. So I refer to this crisis as the liquid crisis. I mean, we've seen some of the residual effect in the stock market, of course, because of that liquidity injection. But the difference between this crisis and the last one, that was very slow and therefore gradual to recover from, is significant. All of this led to a lot of activity between our sales force and our clients from March of last year. And every quarter we did a little bit more business, leading to fourth quarter where a lot of the delayed transactions, a lot of canceled transactions could now be reconsummated because more capital was available. There was a little bit more certainty. Especially in December, we started to get some positive vaccine news and people were starting to see the light at the end of the tunnel. But what really paid off was, of course, the technology and the training and being out there with our clients, but the philosophy, 50-year philosophy of being prepared and being there with the clients, being in touch with them in the best of times, in the worst of times, and putting on our problem-solving hat when the clients needed us. That really paid off, and it's carrying on into 2021.
And do you feel like, as we talked about your journey at the company, what is something that you feel like you've grown into a philosophy as you've grown from each role until CEO? What's stayed with you, and what's something that you've developed in that trajectory?
Well, I'm really fortunate that I got into the real estate business at the very, very ground level. I was literally a data entry clerk at a competitor starting in 1986 while I was still going to college, and really fell in love with commercial real estate and the notion that information and intelligence can be a decision-making tool, making a broker into an advisor and making a client appreciate the decision-making tool instead of just trying to win their business. And that essentially is how I would capsulize my entire career, including today, is where I saw the opportunity to be a value-added investor to the decision maker through the tools, through the information, and in the process, making the brokers that I was partnered with a lot more effective and a lot more competitive than others who were just trying to do the next deal. That has been, if you will, my North Star, in that because I was in the trenches with brokers, doing client presentations, seeing the feedback, adjusting the tools, adjusting their information, coming back with the next generation of whatever, based on that client feedback. And I've never lost that orientation throughout my various responsibilities at Marcus & Millichap. It's kept me very grounded to be a good listener, both to our clients and to our own sales force. Our own sales force has tremendous ideas. They're in the trenches. They know what they need better than anybody. We need to listen to them. So we make it a point, a philosophy, to have focus group sessions, to have agent surveys, to have client surveys, and constantly listen and morph based on what the client base and our sales force need. So you can never be, you don't want to be the smartest person in the room. You constantly want to be listening and learning and then delivering. And so that has governed my entire attitude as a service provider. Our entire management team that I've assembled since I've become CEO and the leadership team works under the premise of leadership through servitude. Our clients and our people come first, protecting the company comes first, and then everything else will follow. What I've supplemented that with as CEO is the long-term strategy, trying to anticipate where the market is going and being positioned to both respond and on a proactive basis go after certain trends as a way of expanding the firm. The institutional edition that I shared with you earlier is one example of that. When you look at the demographics, we started looking at the demographics about 10 years ago. It was very clear that our private clients were going to migrate up to larger, higher quality assets. And behind them, there was going to be new people wanting to buy commercial real estate as a great investment tool. And we're really fortunate that our business offers a great menu of risk reward. You can acquire an apartment building in a very, very tight market that is supply limited for a low yield, but very safe. Or you can acquire a hotel that has been hit hard with COVID, that'll do well in the future, but isn't performing very well now, that has a much higher yield, but has a higher risk profile, and everything in between. And whether it's by market, whether it's by property type, our job is to really create the opportunities through that menu for the people who need to sell and buy. And commercial real estate itself has become such a strong investment alternative because of its yield profile, because of the fact that it no longer really is overbuilding and causing its own problems like it did for many decades. That the combination of our wanting to be forward-looking and on a proactive basis see where the trends are going and execute accordingly, and the power of the business itself is really exciting to be a part of. It's really a privilege to be in the midst of all this.
So are you of the opinion, like you are in the retail sector, that hotels, that hospitalities are going to get back when things start opening up again?
Absolutely. Absolutely. There are a lot of smaller private operators that just don't have the staying power, didn't have the staying power. Many of them held on as long as they could. Some of them are not able to come out of it. That's the minority of the situation. The majority of the situation, even on the limited service, privately owned, smaller hospitality assets, lenders have been very good to work with their borrowers and modify terms and just be patient. That's been refreshing to see. We've helped a lot of our clients come up with ways to work with their lenders and just buy time. We're working with lenders. One of the acquisitions we made in 2020 was Mission Capital that specializes in loan sales for lenders. So if a lender has a portfolio of performing loans that are doing great, a lot of times they decide to sell that portfolio for a variety of reasons to other lenders or break them up into smaller pieces that retail investors could acquire. And of course, non-performing loans or properties that look like they're going to be non-performing in the foreseeable future, and the lender wants to get ahead of getting that potentially troubled loan from coming on their books. So because of that specialization, and the timing of that acquisition was very good for us. And interestingly, we've been talking to Mission well before COVID, because to your point earlier, what are we doing to really expand the platform? We always saw that as a great addition to our capital markets platform anyway, good times or bad times. It's a great business to be in and a great capability to add to our service offerings for our lenders and our investor clients. Lo and behold, COVID hits, and that service all of a sudden becomes far more important and far more in need by many of our lender and private investor clients. And we're in the midst of implementing all kinds of executions for clients because mission is now part of Marcus and Millichap. So that's another example of not just being reactive to a cycle, but looking 10, 15 years out and positioning the company accordingly.
So in that vein, what are you looking out in the next few years? What are you looking at post-COVID? What are you thinking about now?
Two things. One is to make sure that the people that have invested in commercial real estate, that are in the business, have the benefit of as much education and information as possible, so that when it comes time for them to recapitalize their asset or sell their asset, they're not leaving value on the table. As I mentioned, the market is so fragmented and so many clients still take unsolicited offers from a would-be buyer, and because they've held the asset for a long time and it's a much bigger price than they paid, they're enticed by a quick sale at a certain price. But that asset that has not gone through professional marketing, whether it's through us as an intermediary or somebody else, but especially us, because we bring the research, we bring the technology, we bring the boots on the ground, access to buyers, would be so much better served for being exposed to buyers that want that asset, and a significant amount of value is lost when it's not. So our job is to make sure the millions of people that own commercial real estate, and at some point they're going to refinance or recapitalize or sell those assets, aren't leaving value on the table. That's the first thing. And we've done that, for 50 years. I can't even begin to quantify. Our founder, Chairman George Marcus, often asks me, how much value do you think we've created for folks that probably would have taken a much less lower value for their asset had it not been for our market making capability? It's very hard to put a number on it, but it's significant. We create a premium for our sellers because of what we do. And so educating the marketplace to that, and then if they choose not to use us, great, but at least they're protecting their own interest as much as possible. That's one. The other is all the new capital that's forming, that is looking at yield, looking for a place to invest. You mentioned you're in Tel Aviv. We have a lot of Israeli investors, a lot of investors from other parts of the Middle East, European investors, Latin America investors, having doubled our presence in Canada in the last 2 years has paid off big in looking at international capital that was very interested in Canada and is now considering Canada and the United States. The synergies between our Canadian teams and the U.S. teams are phenomenal. And being able to move capital that meets the investors' needs are a significant part of our agenda going forward. So the new capital is forming also needs the education and the options of safe, low risk, low return, and maybe higher risk, higher return types of assets. Internally, productivity, productivity, productivity. If we can help our brokers get trained quicker, if we can convert more of the people who come in with no experience and who we train to successful brokers, I mean, it's a very high burnout rate and it's a very high turnover rate because our business has a huge barrier to entry. It takes a lot of sales skills, persistence, and of course it's a commission-based platform, so you have to have the staying power to make it through. But those that do make it through have a phenomenal career opportunity as they build client relationships and so on. Most of our top producers, the vast majority, 90% plus, joined the company 10 years ago or more. Actually, some of them less than that, with no prior experience, and are multi-million-dollar producers now, with a great book of business and great client relationships that'll pay off for a lifetime. So how do we bring more productivity to the individual broker, whether it's through technology, advancements in training, advancements in the way that we deploy our management? We're the only firm in the business from day one. This is, again, goes back to George Marcus. The vision was to have the boots on the ground, to scale the business that is going to cater to literally millions of private investors owning millions of assets across the country. Takes boots on the ground, takes training, takes management and supervision, and having a manager that's been a broker but is now dedicated to management without being a broker. So a non-competing manager, not a player coach, but a dedicated executive of the firm that's compensated based on the success of the whole office, not one or two brokers or doing one or two deals, is the paradigm of our company. It's very unique. And that managed sales force with 45 plus regional managers and 5 division managers that supervise them across North America, and a leadership team, all of whom grew up as brokers, managers, and are now leading the company, are there to make sure that the productivity, essentially, of every individual on the team is at a premium. With everything we've done, I still know we can do more. I still see opportunities in surf learning, virtual training, and all kinds of advancements in our tools, information delivery, automation of a lot of the manual work that goes into underwriting an asset, that will make that productivity curve much more attractive. That's a huge part of it. And last but certainly not least, the continuation of acquisitions. We have so much opportunity as we're proving the firms that join us really benefit from the tools, the management, everything I just talked about. And then they bring market coverage and access to clients or expertise in a property type, or in the case of financing that we currently don't have in that particular location. We're not looking to overload and oversaturate coverage we already have with our own team. We're looking to supplement our own team with gaps, whether it's in these property types I talked about earlier, shopping centers, office, industrial, or on the financing side. And there's just it's a massive market with huge opportunity.
You know, listening to you talk to you, there's something that I'm reminded of is this notion that it feels like some of the best CEOs, some of the best management teams have come up through the ranks, and as you described, really learned the minutia of what the job is, and not just their job, but the whole ethos of the company. And you really can't learn that unless you're really in the trenches doing that. Do you agree with that? Do you feel like that's something like really essential to management, even if you haven't come up through the ranks like you have, but if you've spent the time getting your hands dirty?
I very much agree with that. However, it could also be a limitation. It can also be a trap, because as a whole team has the common denominator of having come up through the ranks together, with the same company, your vision can become limited. All of a sudden, you can limit each other's thinking. Being keenly aware of that, last year we brought in a new CFO that comes from outside the real estate industry. He has a technology background, Silicon Valley background, startups in telecom and other forms of technology. He's been a public CFO before, didn't know anything about real estate, but he knew a lot about acquisitions. He knew a lot about managing sales forces. He knew a lot about technology deployment. And so that his sort of fresh perspective into a 50-year model that we've constantly tried to reinvent from our own internal experiences and listening to our clients and so on, all of a sudden gets augmented from someone coming in with a brand new perspective and fresh set of eyes and expertise in other fields, going, hey, why don't we think about this? Why don't we do it this way? We brought in a chief legal officer that came from the private equity world, that's done a lot of acquisitions, a lot of workouts internationally. And so he's really experienced in all the nuances of deal structure and the best ways to deal with the accounting side of acquisitions, as well as the legal side of acquisitions, but the creativity, most importantly. We brought in a corporate development leader a couple of years ago that had been in the real estate business and helped a number of firms become roll-ups through many acquisitions. And again, within the industry, had the acquisition experience that we thought would really supplement where we're trying to go. We have the organic growth expertise among ourselves, but we haven't grown up as an acquiring firm, if you will. That's new to us. We've acquired 9 firms in the last almost 2 years now, about 18 months. And there's a lot more to go, and we can scale this. But we needed to add that skill set to our own internal expertise. So I really think it's a combination, because as soon as you start to sort of get insular and inward in your vision and your understanding, you could miss some trends and you could miss some opportunities.
Yeah, it's a great point. Probably most essential of all is to be aware, and to be aware of the blind spots. It seems probably
Exactly.
you have to be curious and open-minded in order to be successful in that kind of role, I guess.
Yes, and never getting comfortable. The biggest
Yeah.
mistakes in corporate America are made in good times. I've seen it happen. I was with a firm, Grubb & Ellis is where I started my career. Phenomenal firm, very entrepreneurial, phenomenal founder. Hal Ellis himself is a dear friend, and a friend of George Marcus's, actually. Just a charismatic, amazing icon of the industry, but was so ambitious and so aggressive in the growth, huge acquisition curve. And that company got ahead of itself and got over its skis and took on too much debt and no longer exists. I was fortunate to have met Bill Millichap and George Marcus at the peak of my career there. I've been with Grubb & Ellis for 11 years when I met Bill and George. And the idea that they had this private company that they cared so much about and they wanted it to be healthy. They weren't looking for ambition and growth goals to overtake. The delivery of the quality of the service to the individual client, to the individual broker, was so appealing, and it's one of the best decisions I made to join forces with them and take the notion of always being there for the client and always being ready in a cyclical marketplace to fruition as a member of this team has been an unbelievable experience.
Very good. That's awesome. I'm going to leave you the last words if you want to share with investors what they can look forward to with Marcus and Millichap, why they should be investing with you. I'll leave you the floor.
Thanks. I really see it as a long-term prospect of taking everything we've talked about, whether it's the size of the market, the fragmentation of the market, the fact that we're the leading brand in the largest segment of the market. 84% of sales, commercial real estate sales in the US, are sub $10 million in value and dominated by the private client. That's our client base. Yet we only have a 10% market share. So through better execution, through technology, through all the advancements that I talked about, we are very excited about increasing that share and exponentially growing the platform, both organically and through these complementary acquisitions. On the finance side in particular, we're looking at a variety of ways to expand that capability to the same client base and rounding out the overall value proposition to the client. And of course, the balance sheet, the way we have run the company in a very aggressive yet healthy fashion by accumulating a record number of dollars per share on the balance sheet and having no debt really positions us incredibly well to execute on this growth plan.
Well, Hessam, thank you so much for such an insightful and thoughtful conversation. It was really a pleasure to talk to you, and I'm sure investors have gleaned a lot about why they want to put their money in MMI and also about the real estate sector in general. I think you've given us a lot of things to chew on and think about going forward. I hope this is the start of a continuing conversation and we get to hear from you again and share with investors. This was a great conversation, so thank you so much for today.
It was an honor to be a part of it. Thank you so much for having me.
Pleasure. Thank you.